The following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It's time for Volatility Views, the premier radio program for volatility traders. Each week, we'll dive into the world of volatility, how to manage it, profitable strategies, and how to avoid the pitfalls of trading volatility. If it involves volatility, you'll find it on Volatility Views. And now, the Volatility Exchange is proud to present your hosts, Mark Longo and Don Schlesinger.
Welcome back to Volatility Views, and I hope all of our listeners out there have been having a fun and profitable and exciting trading weeks, and certainly there is no want of excitement in the market these days. We are vacillating all over the place, maybe light on volume, but there certainly is some movement to attract, and certainly some movement in volatility, which of course is our purview here. My name is Mark Longo from theoptionsinsider.com, and I will be your host for this soiree through the world of volatility. And I am joined, as always, by my ever-faithful, the yin to my yang, good old Don Schlesinger from the Volatility Exchange. Don, how are you doing this fine Friday afternoon?
Just fine, Mark. As always, great to be here. Looking forward to our guest and to some interesting discussions about a format of volatility trading that is perhaps less widely known. So I look forward to speaking with Kirk in a little while.
Yes, we do have a guest coming up, and that will be very interesting to get to that. But before we get to that, we should dive right into our volatility review.
It's time for the Volatility Review.
Welcome to the Volatility Review. This is, of course, the portion of the show where we review the volatility trading activity and the volatility action that we saw over the previous week. And, of course, as is our wont at this time in the show, we throw it over to our volatility pit reporter, good old Mark Sebastian from OptionPit.com. And Mark, what were you watching in volatility for the past week?
You know, what's interesting is how much vol there was for nothing to happen. You know, we've been up big, we've been down big, and then gotten nowhere. It's like we keep taking monster steps forward and monster steps back all week. You know, as I look at kind of realized vol, if you look at, you know, if you measure vol kind of distance from close to close, huge vol. If you measure vol from kind of a high-low standpoint, almost nothing. If you measure kind of range vol, you know, the range, intraday range, huge. So it's all about kind of what are we looking at. So, you know, if you do the math, take a look at it. We opened the week at 1271, okay, up a touch. You know, I think we opened up 1271 and closed 1278 on Monday, and then today we're trading 1269 right now. I mean, so for how much vol there allegedly has been, the market is doing nothing. I mean, nothing. The only really interesting trade in terms of volatility has kind of been the some of the currency trading in like the euro. There's been some interesting stuff, I think, on that end, but I mean, nothing in the equity markets.
Yeah, we've kind of just been vacillating around this same point. But then again, that is in the purest, rawest form. I suppose the definition of volatility. You're vacillating around a point, but you're moving. Yeah, it doesn't have to be directional. It can move. But yeah, I see what you're saying. Where, you know, we're not plummeting to the downside or anything along those lines. We're kind of just vacillating with very little underlying activity. Of course, that's to be expected. I know you love that phrase, sell in May and go away. In fact, I think it's tattooed on your forehead. And this time of year, we expect these kinds of swings with very limited actual trading activity to drive them.
Yeah, no, it's really, really interesting. You know, I'm kind of with the way we're moving. I mean, what's stopping people from just unloading premium here? You know, I look at SPY or SPX or ES, any of those contracts, and the 1250, 1310 strangle looks like in July looks like a huge sale.
In all of those, you think they're all sales?
I mean, they're all kind of the same product.
Where's the ES one trading right now?
The July S strangle, I was looking at this earlier today. Let's see, $16, and you get about $23 out of it, $22 out of it. So that's not a bad sale.
1270 or 1250 1310 or 1270 1310.
1250 1310. Yeah, you get 16 and 5. Yeah, so let's call it $21. So I have trouble imagining the market getting to 1230 or 1330 right now. I don't see it, especially with the 4th of July coming up.
That's true. We have that nice long holiday weekend coming up, which tends to sap all the vigor and the premium out of the markets.
Although I would point out that if you look last year at SPX volatility, the final huge kind of pop that we had last year in terms of vol took place the day before the 4th of July. It was on July 2nd that the market hit that low. Everyone
getting out before they escape to the south of France for their long weekends.
Yeah, the market hit its absolute low. Vol peaked on the 29th or the 28th, and the market hits low on July 2nd, and then we just came out of the gate from then on, and we had that huge rally all the way through Labor Day. Do you remember that?
Vividly.
I love it. So it's interesting. You know, maybe we do sell off into the July 4th weekend, but man,
watch for a potential pop right before the long weekend. You're saying?
Yeah, I mean the real pop was like the 30th. Vol, even as we dropped a little bit, vol started to come in on the 2nd before it just absolutely got smoked and the market took off from then on. So it was real interesting.
Well, thank you for that, Mr. Sebastian. And of course, we cover the broad purview of volatility products and volatility trading here on Volatility Views. And one of the more interesting and more active areas has been the Euro Vol and, of course, the Euro Vol contracts that Volex has listed. So what have we been seeing in the world of Euro Vol for the past week?
Well, it was another interesting week. We've had quite a lot of movement in the euro. It's actually being talked about quite a bit as you look at CNBC or simply study the markets and what's going on. And of course, that's translated into continually high levels of volatility. Traditionally, just as a benchmark, 1 year euro volatility has been around 11 or so, and even past 3 month volatility in the mid 11 range. We're currently at 13 3/4. Last night's settlement in the front month, 1 month July volatility product. And that's about 14 days into the 24-day expiration period. And the calculated volatility for those 14 days is still rather robust, up at 13.80. So we're seeing it in both the 3-month contract, which not surprisingly is a little bit lower, settled at 13.34 last night, perhaps an indication that these high levels might not be quite as sustainable over a longer period of time. But we're certainly at levels that are a lot different from the 7s and 8s that we saw back in February and March when we first introduced this contract on the CME. And traders and investors and users of the product are surely getting some bang for their buck and some movement in both the 1 month and the 3-month contracts.
Yeah, I'd imagine it's quite the roller coaster out there lately. And can you give us any updates on volume? What kind of numbers are you seeing out there on some of these products?
It has been, and of course, as always, it's the chicken and egg problem. We've got a lot of institutions and hedge funds and people who are have expressed a great desire to trade the product and kind of waiting for the volume to pick up to even higher levels. And of course, you always want to say, well, someone's got to dip the toe in first in order for that to happen. But we still have our Optiver and Infinium and RSJ market makers in there, making markets on a regular basis, keeping the spreads acceptably tight for people. So we continue to see small advances, and it's a process, and we hope more traders will take a look.
Of course, and I'm sure many of our listeners, too, are looking forward eagerly to the day when you add some additional products so they can dive in and start playing with these products that they've been hearing so much about for so long.
We're definitely working on it. The meetings are ongoing, and we hope that it will not be too long before we'll have further announcements.
All right, and that is going to do it for the Volatility Review. And now we're going to roll right into our Volatility Viewpoint section.
Now it's time to discuss volatility and volatility trading strategies on Volatility Viewpoint.
And welcome to our Volatility Viewpoint segment. This is, of course, the segment of the show where Don and I bring in someone from the world of volatility and volatility trading, and we pick their brains on the show. And today's guest / victim is Kirk Northington, and he has a wide range of credits to his name, as well as a wide range of endeavors. He is, of course, the author of the book Volatility-Based Technical Analysis. He also runs Northington Trading, LLC, and he's also the creator of the MetaSwing system, which is both a TradeStation plugin as well as a few other things, Kirk?
Yes, TradeStation and Metastock.
Well, Kirk, welcome to the program.
Thank you. Appreciate you having me on.
And Kirk, you operate in a very unique segment of the options and the volatility world, so I'm very curious to dive into that. But before we do, since you do operate in such a unique space, and because this is your first appearance on Volatility Views as well as on the Options Insider Radio Network, why don't we take a minute for you to fill our listeners in on some of your background in the options market and how you found your way into the relatively targeted field, let's say, of volatility technical analysis.
Sure. Like a lot of people, I started out trading as a private individual and was looking for something that worked for me. It didn't take me long to get through fundamental analysis to know that wasn't my thing, and to find my way over into technical analysis. I couldn't make standard technical analysis work on a regular enough basis to live inside my risk profile as an individual. And so I began experimenting with programmable technical analysis platform, Metastock, and a couple of others. And my background is a little bit more technical. I come out of software configuration and engineering in the control system space, doing process controls and large facility controls. And in those spaces, we had to do a lot of adapting to physics, so to speak. And so I apply some of those concepts within the analysis that I do. And that took me forward to programming my own algorithms, indicators, etc. And as I like to say, just one thing led to another. If you have a goal that you want to achieve, you just keep working until you get there. And it's funny how it will take you down a path that may not be pointed down the direction that you started out. And so I began creating algorithms to measure extremes because I went with the buy low and sell high method quite literally. I was trying to find the absolute low within a given time frame and the absolute highs. And it turns out that volatility-based mathematics identifies that very well. And so after a few years of this, I ended up with different tools that were aligned with traditional chart-based technical analysis concepts. And that's really what surprised me, was how much I had after a while. And then it didn't take me long before I figured I wanted to do this full time. and I tried to work out a business model to where I could develop as a trader and at the same time do one of the things that I truly love, and that was develop methodology and trading tools. And that takes me to my current business model, which is what I do. I license my trading system tools called MetaSwing, and at the same time I trade my own money, maybe not to the frequency that many people do. I go on and off as far as trading, but I'm always developing and supporting existing customers. That's kind of a little background on me.
Thank you for that. And now I'm glad you mentioned some of the differences between what you do in traditional technical analysis, because that is, of course, I think a lot of our listeners, and my own first question when we hear volatility technical analysis is, of course, technical analysis in the option space is a little bit of a different game. Most of the ways that it is applied is on the underlying. People will look at the underlying, they'll try to find some indicator that they like or some way of charting or predicting the underlying, and once they have a feel for where they think the underlying is going to move, they will trade their options accordingly. There are very few people who actually do technical analysis on the option price itself, let alone on a component of the option price, which is, of course, volatility. So you mentioned high, low, and some of the other techniques you use. Give our listeners an overview then of some of the other techniques you use and how volatility technical analysis really differs from what they may be accustomed to with traditional equity technical analysis.
And
Sure.
Mark, if I may, and before Kirk answers, I just would want him to incorporate in his answer something that's very important to me as well. When you mentioned a component of options, namely the volatility, that would be implied volatility. So I want to make sure that we understand that Kirk's techniques in studying volatility and analyzing it technically and then applying that as a predictive tool. Are we talking about implied volatility? Are we talking about realized or historical volatility? Are we sometimes talking about both? So I want to make sure we make that clear.
I think that's an excellent point to make clear. Let me first say that what I practice is chart-based technical analysis. I don't analyze the different technical measurements in the option world of Greek measurements, etc. I wouldn't be someone to improve on that. What I think that traditional chart-based technical analysis lacks is enough attention to volatility in its underlying mathematics. And so to answer your question, yes, I don't analyze implied or real-time volatility in that sense. I analyze strictly historical volatility to project forward different values and trading limits, if you will. So to get a little bit more specific, when we look at the chart itself, I shy away from patterns and I shy away from strictly what you'll find in the public domain in terms of momentum indicators and things like that. But yes, we are trying to find the direction of price, but we're also trying to find those limits where things have really just gone too far within a given time frame, if you will. And I like to make sure that whatever methodologies I'm using, we can leverage many different time frames on the chart, okay? But I think that there's been a missing link between option analysis, option price analysis, and option implied volatility analysis, etc. I think there's been a missing link between that and traditional technical analysis. And that's kind of the niche that I like to fill. Yes, it's done on the traditional bar chart or candle chart, but nonetheless, it's somewhat in between. I do that by infusing volatility arithmetic inside of every chart-based or oscillation-based indicator that I use. Okay. When I say volatility arithmetic, what I'm specifically referring to are things that you learned in high school. It's really not that difficult. So we're talking about a standard deviation. Of course, a lot of people are familiar with that. We're talking about a linear regression calculation. It's not something that's fun to do by hand, but you can certainly get it everywhere. We're talking about standard error. We're talking about something called R squared, and 2 or 3 others that come in very handy when you put them into a traditional chart-based analysis tool.
Now you're really talking more about using volatility and technical analysis to inform your more general technical analysis, as opposed to focusing all of your trading based around the indicators generated from a volatility technical analysis then.
I think so. I think if I understand your question, yes, I think that's accurate. Yeah. One of the things that's important to realize is that in the world of trading, there's a big difference between the world of mathematics, which is used to dealing with what they call rational numbers, statistics and such. Those are standard distributions, if you will. Whether you're dealing with physics or science or whatever, there's a lot of predictable qualities to that. In the world of trading, we're dealing with people, and we're dealing with people's irrational decisions, and that's why prices gyrate the way they do, and why we get noise and all this and all that. We're dealing with irrational numbers in a way, not to use that term technically. And so still, the characteristics of the type of math that I use, infusing it into traditional technical analysis, you're still getting a lot of benefit of the predictability of identifying outliers, you see, identifying the extremes to which price can go to within certain time periods. But still, it doesn't get rid of all the noise. And we are on the chart, but those extremes are important. I start with volatility bands that tell me really what are the limits on a real-time basis, not necessarily projecting forward. And I'd like to point out that from a technical analysis standpoint, I'm standing on the shoulders of some people who did a lot before I came along, and that would be Wells Wilder and his great book that he introduced in 1978, full of an awful lot of indicators that still stand the test of time today, like the RSI oscillator that everyone loves, and average true range as a measurement. And then also on someone named John Bollinger, which everyone recognizes as the founder of Bollinger Bands. I take it a bit further, and I tend to make projections going forward that tell us when things will incur time delay, as in maybe price will stop at that point, or it will reverse. And in my book, I outline 2 different concepts that we utilize from volatility analysis on the chart. One is projected implied volatility. And I realize that I'm walking a fine line by giving something that name. But it's essentially, it's not implied volatility, nor do I definitely don't want to diminish the value of real-time implied volatility. But in order to take something and project it forward as a support or resistance point on the chart, that's what PIV, or projected implied volatility, is. It's a new form of support and resistance based on volatility analysis. I blog on this topic at the Market Technicians Association and internally, and I also publish that on my public blog as well.
I think that's interesting because we see a lot of talk these days, particularly now that the market is having some issues maintaining its current levels, and we're seeing a lot of vacillations. We're seeing a lot of discussion about support and resistance in the broad market in the S&P, and everyone always quotes a level. They always quote, a price level, 12.5, 1,300, whatever it might be. I very rarely, if ever, see anyone quoting a volatility-based support and resistance. So that makes your approach relatively novel, at least in terms of the way you're looking at it from there. Let's get into that a little bit then. What are your current vol supports and resistances right now for what we're looking at in the S&P right now?
Well, at my blog, the most recent blog that I published, I believe it was on the 12th of June, I came to a support level for the S&P, a support zone between 1224 and 1243. And that's on an intermediate basis. So, which would be approximately 6 to 8 weeks from the time that I published that. So, for the majority of the summer, I think that will be support zone. We haven't reached it yet, but if things keep going, we'll probably get down into that.
And what does that correlate to on the skew curve for volatility there?
I really don't think of things in terms of that. Essentially, this support zone is determined by my volatility bands and the projected forward support level that they project. This was derived from a weekly and a 3-day chart analysis time frame that both overlap. You can actually see the way that I derive this from my blog, so you can see it if you'd like. It's at tradingtheinvisible.com, and then click on author's blog.
Yeah, I definitely encourage all of our listeners, if they are interested in learning more about some of the metrics or learning more about your book, then by all means visit that URL, tradingtheinvisible.com.
Kirk, I have a question. I think it probably relates a little bit to what Mark was just asking, because I think he had in mind certain support and resistance levels, not just for the underlying asset, in this case the S&P, but actually the volatility, the realized or historical volatility itself, which then becomes an indicator to you for what price movement might be. So I guess I have a question that relates to that, and that is, as you obviously well know, and we've spoken about it many times on the show, at least in the equity markets, there is a very strong negative correlation between underlying equity price movement and volatility. Namely, when prices tend to go down, they often do so rather sharply, and volatility increases. And when prices go up, they often climb a wall of worry and do it in a more orderly fashion, and volatility tends to abate somewhat. So if that's true, and we all believe that it is, then as you're looking at historical volatility, you're obviously looking at volatility that has already been caused by price movement. So in a manner of speaking, that volatility and its level is sort of a byproduct of the actual asset price movement itself. So I wonder if, in using volatility to help you in your technical analysis and your predictions, we aren't kind of almost like one step removed from really kind of saying that because that volatility is generated by the price movement, that we really kind of are looking at the price movement of the underlying in order to drive the technical analysis, but we're doing so with a kind of an intermediary of volatility. Does that make sense to you?
Yes, absolutely. It's once removed from the actual price movement. I like to think of it more as where not is price moving, but where is it likely to go to? We may not be saying the exact same thing, but I think our thought processes take us to the same. Does that make sense?
Well, I guess I'm trying to see exactly what you do with the volatility numbers that you study in order to then turn them into, in this case, equity price movement, support and resistance, or predictions itself. So I guess I'd like to kind of ferret out a little bit more of the actual process itself.
Certainly. I use a set of volatility bands, and they're my own proprietary bands. They're quite a bit different internally, the way that they're calculated, than you've seen in other types of volatility bands. specifically to derive support and resistance, I look at peaks and troughs in those bands. And that's really the key to it. The extremes of volatility at a given time frame. Okay? The peaks and the troughs project forward support and resistance zones. Okay? That's probably the best way to describe it verbally. So also what's important is you really need to look at more than one time frame in charting. And I think that's one of the great contributions to analysis that chart-based technical analysis makes, is it gives us the ability to analyze things in different time frames. So I'll typically take a daily, a weekly, a 3-day chart and find where they agree. When they both are, when two or more are projecting forward the same support and resistance level, or peak and trough level, if you will, then that says an awful lot about the players that might move price to that point and what they may do at that point. So the key is extremes, and so I use peaks and troughs of volatility bands that I have to derive actual support and resistance.
I'm curious about something else. Obviously, this methodology and this approach is not limited uniquely to equity, and I assume that you apply it over a wide range of assets. But very often, as we see with any kind of trading system, whether it be futures or options or otherwise, sometimes a particular approach or a methodology is more pertinent or more applicable, or simply tends to work better for one kind of asset than it does for another. So I'm curious, as you go to apply this general approach and this general volatility-based analysis methodology, whether you have found over the years that it works somewhat better or more reliably for certain assets rather than other ones.
Yes, I have found it. It is inherently applicable to most any chartable security or asset. They use it in futures, they use it in equities, of course, and also in foreign exchange. Obviously, myself, I don't trade all of those. I do believe in sticking with something that you know and not trying to be the master of all. But I have a lot of clients and that use my software, and they trade all of these markets. I guess to be specific, what I have found is that different portions of the analysis seem to work better on different asset classes. For instance, with indexes, with equity indexes, I use the N bands, and those are my volatility bands. I use those an awful lot, and I use the projected forward support levels a little bit less so than I do with the individual equities themselves. When we get into futures, the projected forward support levels seem to work extremely well, and I was able to get within a 1% prediction of resistance on natural gas just within the last couple of weeks, where it peaked. I had a resistance level at 503, and it did peak at 498. That was also I also had that historically in my blog as well, and so I applied that support and resistance methodology to that, and got pretty doggone close to what's been fairly volatile little asset class to track. So I find that the different tools will work a little differently from class to class, but I do find that the approach works well across virtually all asset classes. Now, one limitation that I want to add is that it requires a lot of data. You may find a lot of technical tools that may require only 50 or 100 bars of data on a chart, Whereas what I'm doing typically requires 500 to 700 bars minimum. So with something like a future, you need to have a continuous chart, not for a specific month, but a continuous chart constructed.
Let's keep on the broad methodology for a minute, because when I was on the trading floor, I encountered quite a few varying and sometimes conflicting views on technical analysis. You had the adherents who were very devout in their beliefs. It's almost a religious dogmatic schism. And then you have the skeptics.
We've all met those.
Exactly. You have the skeptics who say it's nonsense and really can't use what previous history of a stock's chart to predict where it's going to be. One area where I think a lot of those people on both sides tend to agree is that the validity of an indicator tends to grow the larger and more widely and broadly it's followed. The more people you have following something like, let's say, a low-hanging fruit indicator like Fibonacci, where they can then look at that and put in their levels of support and resistance, you're going to see a lot of orders in the book, whether they're from retail or for whatever it might be, at those support and resistance levels, because people tend to follow those indicators. Whether or not they're relevant is moot. People are following them. They will have at least a little bit of impact on the day-to-day flow of that name. Now, something like volatility technical analysis, analyzing, as we discussed, essentially a derivative of the underlying, a very small core segment of an options price. You're one of the few people I've talked to that actually has discussed this topic, so I would imagine the number of adherents to this approach are relatively few. So what do you say to the people out there who are skeptics because there are so few people using it, and how do you generate reliable metrics from an area when you and a handful of others are really the only ones who are performing that type of analysis?
Sure. That's a great question. In terms of technical analysis, the thing that technical analysis historically has suffered a little from is that it would welcome in some forms of analysis that were just not welcome elsewhere, like, believe it or not, moon phases or, strange cycle analysis.
I love
like
trading
that.
on moon phases. My moon phase fund is doing quite well. Thank you very much.
Yeah. And, I'm surprised we haven't sometimes even seen moon rings in there or something, if you remember those from the 70s. But the thing is that technical analysis, you're right, it has a lot to do with how many people are using it. But it also has, I would argue, even more to do with how valid of a technical analysis subform that it is. Inherently, technical analysis is supposed to be able to mathematically model the behavior of traders. That's why we use it. It isn't so much supposed to work because people are watching it, although that is a byproduct of it. If enough people are watching the same indicators, sure, their behavior is going to tend to highly correlate. But what good, successful technical analysis is supposed to do is it's really supposed to give you an insight into the behavior of the people who are actually buying and selling, and the groups of those people, all within the same time horizons. Okay? Now, I personally believe that good, responsible technical analysis should be quantifiable. Not everyone agrees with me, but a lot of people do. One of the things that I practice at Northington Trading is, for the vast majority of the tools that I publish and allow people to subscribe to, is I test them quantitatively. I put a lot of time and effort into software that conducts statistically valid backtesting. And I say statistically valid because that's what's lacking from so much backtesting nowadays in the technical analysis world. I follow the best practices as outlined within the required reading at the Market Technicians Association for statistically valid testing. And I publish this. So if I have a particular indicator and someone wants to know its performance profile, I give them documentation showing its actual performance profile and how it works within a 20-day window and across a large section or sample of trades, etc. Don't want to get off into the weeds and the statistics, so we'll put everybody to sleep. But I think that good technical analysis needs to do two things. It needs to really model the actual behavior of traders and their irrational behaviors. And then also it needs to be quantifiable. And that takes a lot of the mystical or skepticism out of many technical analysis methodologies that you've seen in the past.
I'm glad to hear that you're taking that approach, because we do a lot of interactions on all various aspects of the options market, beginner retail, high-end retail, institutional, and it seems like whenever you go to an event or a show that is geared around retail, there are no end of people there selling some sort of system where essentially all it is sell when the red triangle shows up, buy when the green triangle shows up, or this is a magic buy, this is a magic sell point. There's no transparency there as to how they're calculating those. There's no probability there that this is a 30% buy signal or something along those lines. It's essentially, they try to break it down into the most broad terms to appeal to the widest audience possible. And I think you're right. That does paint the entire sector with a bit of a broad and negative brush with those people operating within it with that type of approach. So I'm glad to hear that you do take a little bit more transparent approach and you discuss your methodology and probably get into the probabilities of your different buy and sell signals and all the different things that make it a much more nuanced, transparent approach for your audience.
I really try to. I think it's something that the industry and our subsection of it really needs. When I first published my software, I had this 90-page user guide. I still have it. And then my wife walked up behind me one day and said, "That looks great, but nobody's going to read that thing." And pretty much she was right. It's hard to get clients to read it. So we really transitioned to making a lot of things in video format. So I try to document the methodology and all the things behind it with a lot of user videos in short, 15-minute segments, so that people will understand why you want to take an opposite position when you see a specific condition or signal. The why is what's really important. You can't buy success in the form of an up arrow or a down arrow and a magic box.
Kirk, I have two questions, actually. The first one, I guess, is pretty simple. For the time being, have you limited your trading to a personal account and running your own money, or do you have any ideas to branch out and apply your methodology to something like a hedge fund where you'll run money with this technique?
Well, currently I only trade my own funds, and from what my friends tell me that trade other people's funds, they say I should count my blessings. But at this time, I don't have plans to trade or manage other people's funds or money. I do have some plans in the next couple of years to conduct a broader spectrum of proprietary trading, and probably a bit more algorithmic than anything. I partner with a couple of other people, and we trade ideas back and forth a lot, and I find a lot of benefit with that. One of the things that I suffer from is that I create a lot of methodologies, or a lot of tools, if you will, that work out statistically, okay? And I publish and make available the ones that I feel people can actually trade, okay? There are a lot of them that identify statistical outliers that are valid trading opportunities that really just aren't compatible with human trading. So I've got a lot of backlog of methodology that I'd like to implement on an algorithmic basis. Not necessarily high speed. I'm not a real fan of the high speed trading segment, but algorithmically, I think identifying outliers through volatility analysis is the way to go.
Mm-hmm. Very interesting. My last question, at least the last one that comes to mind now, is I don't know if you had any time at all to take a look at the Volatility Exchange, or the fact that we now have listed realized volatility futures contracts that actually settle to the actual or historical volatility of an underlying asset. But of course, along with trading volatility itself, which formerly was done with vol swaps or delta neutral hedging straddles or some of the VIX products today, comes naturally an inclination to want to predict where volatility is going, if in fact that's what you're trading directionally as the underlying asset. And we mentioned on the show before Professor Robert Engel and the Volatility Institute at the Stern School of Business and all of the pioneering work that he's done on Arch and Garch modeling. So I guess my question to you is, as volatility studies and technical analysis is an integral part of what you do, but for the purpose of really predicting price movement of some other underlying asset like the equity markets or whatever, have you ever simply turned to volatility trading in a purer sense and tried to use your modeling to actually trade volatility price movement through any of the instruments that I've just mentioned?
I have not personally done that, but I think that you're definitely describing something that is a natural to be traded. Taking into consideration the models that you mentioned with Arch and Garch, and the cyclical nature of volatility, I think that there is a lot that could be gained there. I find it fascinating, and I'd certainly like to devote some of my time to looking at it. So we may be talking some in the future.
Well, yeah, I'd like to, because I think the concept there is either it was because of lack of really appropriate vehicles, you're more realized volatility based, so the VIX might not appeal to you, and the over-the-counter swaps markets are really not accessible to a wide audience. They tend to be very capital intensive and institutionally oriented, and we know what potential problems there are for straddle trading. You don't always capture the volatility that you're looking for. But now with the advent of our one product on the Euro FX, and hopefully many more to come in the future, you might have an exchange based, transparent, much more easily tradable product. And I think it might be a lot of fun to apply your methodology to it and see where that might lead.
I can think of a couple of ways that we might be able to do some things. I have one particular method that doesn't get used much by my client base, but it's called a compression condition, and it's when different levels of support or resistance are tightly aligned within a specific time frame in it. And I've shown that it tends to reduce volatility by 36% within a certain time window, and it's really totally hidden by other methods. And I'm in the midst of doing an historical study on compression and its effects on overall markets. But I've seen some very interesting things with that recently, so I'd love to explore some of that.
Sounds great.
Well, Kirk, I'm glad you can make it on the show. We are running a little bit low on time, but I do want to give you a chance to mention any other ways that our listeners could find out about what you do. Of course, you mentioned your blog at, I believe it's TradeTheInvisible.com? Trading the Invisible.
Trading the Invisible is actually the site for my book, and you can just click on author's blog right there. And then my primary site is MetaSwing, because that's the name of my software, and that's META and then swing. So MetaSwing.com, and you can reach us through either of those sites, or just send an email to Kirk@MetaSwing.com. We'll be fine.
And the MetaSwing and your plugins for TradeStation, if our listeners are interested in picking those up, are those one-time fees? Are they more licensing those on a monthly basis? How does that system work?
We license them on a monthly basis. You can also get an annual basis, but we don't charge a one-time fee. We want to make sure that we can always control the capacity of the system so that it doesn't get overused and such. So it's strictly a subscription, yes.
Well, Kirk, thank you very much for coming on the show. It's an interesting topic that is not covered, to my knowledge, at all in anywhere in the volatility trading or in the options trading space. So it's a very interesting discussion.
Certainly. Thank you very much for having me. It's been a fun conversation.
Thank you, Kirk. Enjoyed speaking with you and your participation. And giving us a slightly different viewpoint. That's what the show's all about, and I'm sure listeners have heard things that are not common and that added something to their knowledge.
It was very good to talk with you, Don, and thank you.
All right, and that's going to do it for our Volatility Viewpoint section, and now we're going to roll right into our Crystal Ball segment.
And now we take a look at the crystal ball.
And welcome to the Crystal Ball. This is, of course, the portion of the show where Don prognosticates wildly, as well as Mark, and we try to rein them in before they lead our listeners off a cliff. No, I am teasing. Of course, this is the portion of the show where we discuss what we're seeing and what we're expecting to see for the coming sessions, and we will start with our volatility pit reporter, good old Mark Sebastian from optionpit.com. Mark, what are you seeing in your crystal ball for the coming week?
You know, I think I kind of summed it up in my report. I can't imagine vol staying this high, both realized and implied, and I am a seller of both. When I look at my crystal ball, I see the VIX falling to 18, by 18 well before July expiration, probably well before probably right after the 4th of July. And that's kind of where my crystal ball is popping right now.
But of course, stay tuned for a potential pop in vol. If things play out as they did last year, then there might be a little bit of movement for the long weekend.
I think we may see a little pop into the official vote on that austerity measure, and the employment numbers aren't until the 8th, which will be interesting. I think you'll actually get really decent numbers. I wouldn't be shocked if they revised May up, and I think now expectations are so low that the market can now kind of start beating things. Oil dropping, I think, I've gotten really bullish kind of automotive sector. I know this isn't a stock thing, but I think we're going to see some people start planning on hiring here if oil can keep below, that kind of keep around 90. I think we're going to see oil fall.
You heard it here, folks. Mark Sebastian says, get long 4 to 13.
And I think currency volatility right after, and, which would be an interesting concept would be, I would be shocked if currency vol didn't just plummet after, at the end of June. Where's the Volex future? Where's the Euro FX vol contract trading right now?
Well, we can toss that over to good old Don Schlesinger, and he can give us all of that info and more. Thank you for that, Mr. Sebastian. So, Don, what are you anticipating out in the world of Euro vol and the Euro vol contracts?
Well, of course, I'm really not an expert in currency trading.
Don, I go to you for all of my currency trading needs. What are you talking about?
You're in trouble, Mark. But I will tell you that I saw an interesting interview with a Forex technical analyst the other day, and he was talking about, don't be in a hurry to buy this dip. I think there's further to go, and I can then see a reversal. We may see the euro all the way up at 149. I think it's about 142 as we speak now. And then when it gets to 149, that's the time to short it. So at least in this one person's opinion, there's a heck of a lot more volatility to come in this one particular product. It'll be interesting to see how it plays out.
And of course, like we said, all the movement we've seen in this contract and all the vacillation we've seen in it does tend to put to rest the questions that have circled around this product since launch, that it won't move with singular data points in the underlying, and that it will require a massive sustained movement in order to generate any real fluctuation in the underlying vol contract. And we've certainly seen that is not the case.
Yeah, and listeners can go to the website. We chart the daily open, close, high, low for all of the contracts over all of the periods. So if you're curious or you have any doubts at all as to whether or not these contracts are going to move for you, just go to the site, take a look around, and I think you'll be pretty pleased with what you see.
All right, and that is going to do it for the Crystal Ball segment, and that's also going to do it for this episode of Volatility Views. And of course, I want to thank my cohort, my partner in crime, my fellow member of our motley crew here, good old Don Schlesinger, for joining me on the program today. And Don, we always give our listeners some updates about what is going on over at volex.us. Is there anything exciting, any new tools, any new developments over on the website that you want to make our listeners aware of?
I mentioned last week that we would actually put up the registration notice and that it would be available by the time today's program rolled around. On our home page, in the first column at the bottom, we have a section called Coming Events, and you'll now find there the information regarding that webinar that Mark Sebastian is going to be giving, that's co-sponsored by the Volatility Exchange, the Price Futures Group, Mark's optionpit.com, and of course the CME. So that registration for the Tuesday, July 12th webinar, that's going to run roughly from noon till about 1 or 1:30 Central Daylight Time, is now available on the volex.us website. If listeners are interested, take a look, register if you like. It's free, and we hope that you'll enjoy that presentation by Mark Sebastian.
And speaking of Mark, he will also be at our live taping of our other program, the Option Block, which will be taking place next month here in Chicago, July 21st, starting at 3:30 p.m., running from 3:30 to 6:30, over at Elephant and Castle on 111 West Adams here in Chicago. So if you are going to be in the Chicago area on July 21st, then you owe it to yourself to swing by and see myself and the Seabass and all the rest of our panelists on that program and have some lively debate, ask some questions, win some free prizes. It'll be a fun event. And Don will definitely have to plan down the road a Vol Views live session too. What do you say?
That sounds great to me.
It's good to get out of the old studio every now and then and press the flesh and meet the fans, so to speak, and interact with them on a personal basis, even more so than we do right now with the forums and Don taking phone calls in the middle of the show. Don's very in tune to the needs of the listeners.
I would, in that vein, say keep the cards and letters coming, but of course we now do it on the forums, and so I do try to be very diligent with that. I check the forums all the time, just answered a question or two the other day, so if anything comes up, please feel free to write in on Volatility Views, and I will try very hard to answer you promptly.
And, of course, we've had quite a few guests on the show over the past few weeks. It's been a great run for us, and so we haven't had much time for the old mailbag, but we will get back to that in the coming weeks. We may even do some more sporadic episodes where we'll do a mailbag episode and a short mailbag episode followed by a longer, more in-depth episode the following week, as it is the summertime and people tend to migrate around, even though our listeners are true and devoted and stay glued to their MP3 players all summer long, Don. I'm not sure if you know that.
Well, you've got a faithful group.
We've got
there's a chance we may take next week off. It is the 4th of July weekend. A lot of people may be celebrating, heading out, leaving a little early on Friday or not coming in at all. So there's a chance that we could perhaps wait until the 8th of July to tape our next show. We'll look into that. And I believe we have one more guest lined up for them. It's Mike Kavanaugh of Know Your Options. So we're going to try to keep those interesting guests coming and look forward to his participation.
Yes, I'm looking forward to it as well. And I want to thank all of our listeners out there for downloading and streaming and subscribing to the show and making it such a success. And, of course, for staying with us during these long, long summer months. We'll see you again next time right here on Volatility Views.
Thank you for listening to Volatility Views. Join us next week as we keep our listeners on the cutting edge of finance and risk management with lively topics relating to volatility. Volatility Views is brought to you by the Volatility Exchange. If you'd like to learn more about VolContracts, please visit www.volx.us. If you'd like to submit a question for the hosts, then surf over to www.theoptionsinsider.com/forum and post your question in the Volatility Views forum. Questions can also be submitted via email at questions@theoptionsinsider.com or via Twitter at twitter.com/options and twitter.com/volx_info. Facebook users can submit their feedback via the Options Insider and Volatility Exchange Facebook pages. Voicemails are also welcome at 312-544-9356. Thanks again for listening, and we'll see you next time on Volatility Views. The views expressed on this program are not intended as investment advice and do not constitute an offer to sell or a solicitation of an offer to buy any securities or other financial instruments and may not be relied upon in connection with the purchase or sale of any security or other financial instrument. The opinions presented on this program represent those of the speakers and do not reflect the views of either the Options Insider Incorporated or the Volex Group Corporation. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.